Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. During this episode, we will discuss what happens in an IRS tax audit, tips on how to avoid an IRS audit, and what to do if you are audited, specifically pertaining to estate and gift tax valuations. We have the privilege to discuss these issues with a former IRS auditor, Mike Gregory. He's a mediator in Minneapolis, Minnesota, author of 11 plus books regarding various valuation topics, and creator of the collaboration effect. He's a frequent speaker at estate planning council events and uses mediation techniques to de-escalate situations. Another question that we have is, what is the role of the IRS agent or a specialist on one of these audits?
Well, you need to focus on who is the decision maker and the ultimate decision maker.
Okay.
So on an estate and gift tax case, the IRS estate and gift tax examiner is your key person. They control the case. They will make a decision on that case. The business valuer is a consultant. Keep that in mind. They don't have ultimate decision making. They're impacting the audit. They're sharing information. But many times, like if you were a business valuer, you look at it as, I'm defending my report against that valuer from the IRS, and I'm going to say why I'm right and why they're wrong. And I'm in here with, actually, let's de-escalate this. Let's figure out what they did, why they've come up with what they've come up with. Let's listen to them like they've never been listened to before. Let's paraphrase, summarize, ask a lot of questions, empathize with why they've done what they, do you have access to BizComps? Do you have access to, different sources, blah, blah, blah. And they're going to come back with that. Yeah, actually, no, I don't. With whatever things. Oh, you know what? Maybe I should show you what we had and what we started with and decisions we made to pare it down. I'm just giving an example. But work your way through that. That may help. And you're also educating who? The agent. Usually think you're trying to educate the business valuer. That's not the decision maker. You want to make sure the agent, the estate and gift tax attorney, understands. And then I refer to the case. It has 3 steps to it. Maybe you got it agreed with that estate and gift tax attorney and with that valuer there. And if you did, good for you and great, and it's gone. Maybe it's not looking like it's going to be agreed, and the agent's saying, I think I'm going to write this up, and I think we're going to have to go potentially to appeals. You go to the second step. The second step is, let's talk with your manager. That's the ultimate decision maker, is the estate and gift tax manager. Okay. So the business valuers are now gone. And the representative of the taxpayer is there. They need to be very well briefed. They have to keep it at a high level. They're working with someone who's probably there to defend their employee, but they also are open to, they prefer a closed case. Closed case takes less time. They're trying to close cases. They have a different perspective than the frontline agent does. They know that they're trying to close so many cases in a given year in a given category, estate or gift, and the subcategory within that. And they may even get a notice in June to say, hey, we're behind in this particular category. We need more closed cases. And they might be oriented towards, we can get this case closed right now in July, get it closed by August, so that our stats for the end of year, which is September 30th, are going to show that case was closed. And they may have an emphasis, let's work this out. So that's with trying to work with the agent and the agent's manager with the taxpayer's representative, which if you're a business valuer, you're not there. If you're the CPA or the estate tax attorney, that's you. And let's say that doesn't work. So we're still looking unagreed. You can always come back to the IRS with another proposal. So I'm commenting to my clients, when you work with the IRS was at 100 and you are at 0. So we start off on opposite ends here. You should determine before you ever talk to the IRS what your best alternative to a negotiated agreement is. It's called BATNA. And maybe your BATNA is 40%. Okay. Between 0 and 40%, I'm going to ask the business valuer to help me develop some numbers based on assumptions in the appraisal and on the discounts, et cetera, that are 3 different numbers between 0 and 40%. We now have 5 computations, right? We have our initial position, we have BATNA, and we have 3 in between. When you're working with that examiner, on exam, you reach an agreement factually. We're not addressing what happens at appeals with hazards of litigation. We are resolving, the key word is we're resolving the issue based on facts. So you need to have computations. So I'm oftentimes working with my client and saying, let's develop some computations. And to keep the business valuer independent, just ask them to do this with that. So that with this DLUM and that discount rate and these adjustments to cash flow. So you're just doing computations. On the other hand, sometimes you're actively involved with your client and you're happy to do this because you see what's taking place. Some say, I did my valuation, that's it. If you want to hire me to do these computations, I do that independently, has nothing to do with my valuation, and I respect that. But we have those. So you've done the first go around with the agent and it didn't work with the valuer. Now you're with the agent and the agent's manager. But before the case closes up, one last call to the agent's manager and say, hey, look, before this goes forward, this is a final offer. I know we only got to the second of, you only got to the second of your three and then the BATNA. And maybe now you're going to offer them the third one, or you're going to offer them the BATNA, because you don't want to have to take another 6 months, 9 months, possibly 2 years at appeals and all the expenses with that. So you're willing to do something now. And now the manager listens to that and says, okay, we can do that. And he's going to tell his agent, we're going to get something from them of how they got that number. We're going to put that into our report. We're going to close it out agreed. You won't need to spend 20 hours closing out the case. It usually takes about 30 days and some time to do it. Instead, it's an agreed case. We can close it out in an hour. You don't have to write an unagreed report and it's gone. And besides, it's another closure. So understanding the interests of the parties involved, which they won't share all that with you that I just shared with you, but understanding the interest. And I come back and I explore those interests. I ask my clients to ask certain questions. And when they ask these questions, the IRS person goes like, wow, this is a much smarter practitioner than normal. And they don't normally ask these questions. And since they're asking me these questions, yeah, maybe this is one I should work towards closure on, because this is a little more intelligent or up-to-date practitioner than some of the other folks I work with.